A real estate company in China collapsed with $300 billion in debt. And somehow your grocery bill went up, your pension took a hit, and the price of building a house in your country increased. And nobody explained the connection. Most finance channels covered Evergrande as a China story, a foreign business problem. Interesting but contained. That is not the full picture. When I mapped every link in this chain, from Chinese construction sites to Australian iron ore mines to Western pension funds to global shipping routes, what I found was a financial contagion that touched your cost of living whether you'd ever heard of Evergrande or not. This crisis is not resolved. It is still unfolding right now. And the people who understand the mechanism are positioned differently than everyone who ignored it. Stay with me, because what I'm about to show you changes everything. By the way, if you're new here, my name is Alex Carter. I've been working in personal finance for 8 years. In these 8 years, I've helped hundreds of people solve real money problems. And honestly, some of those people's lives completely changed because of it. On this channel, I help everyday people understand how global financial events connect directly to their personal financial reality so they can make smarter decisions before the mainstream catches up. All right, let's get into it. Let me start with what actually happened, because most of the coverage you've seen either oversimplified it or buried it in jargon. My situation when Evergrande's collapse became public was this. I was reviewing a client's retirement portfolio, 58 years old, conservative allocation, almost entirely in what her financial advisor had described as diversified global bonds. When I went line by line through the fund holdings, I found Evergrande issued bonds inside a Western emerging market debt fund she'd held for 6 years. She had no idea. Her advisor had no idea she'd care. That conversation is why I spent 3 months mapping this entire system. Okay, so what actually happened? Evergrande Group was China's second largest real estate developer. At its peak, it was developing projects across more than 280 Chinese cities simultaneously and employed, directly and indirectly, approximately 3.8 million people. In 2021, it defaulted on its debt obligations, $300 billion in total liabilities. To put that in context, $300 billion is larger than the entire GDP of Portugal. It is approximately the size of the entire Greek economy. This was not a company going bankrupt. This was an economic territory going bankrupt. But to understand why it happened, you need to understand one number. China's property sector, construction, real estate development, related industries, represented approximately 29% of China's entire GDP at its peak. In the United States, that number is approximately 16%. In the Eurozone, approximately 18%. China built a national economy where nearly $1 in $3 of economic activity was connected to building and selling real estate. And here's the thing nobody tells you about what happens when a sector that large starts to contract. It doesn't just affect the companies in that sector. It affects every industry that feeds it, every economy that supplies it, and every financial system that invested in it. The math is simple. People just don't want to sit with the scale of it. Okay? Keep watching, because what comes next is the part most people never figure out. The commodity chain that connected a Chinese construction site to your cost of living. Here's where it gets interesting. China consumes approximately 57% of the world's total steel production. It consumes approximately 54% of global aluminum, approximately 45% of global copper. The majority of that consumption was driven by one thing: construction. Building residential towers, commercial developments, infrastructure. All of it requiring enormous volumes of raw materials sourced from global commodity markets. When Chinese construction activity collapsed, Evergrande alone had over 1.4 million pre-sold apartments it couldn't finish building. The demand signal that commodity markets had been pricing for years suddenly reversed. Iron ore prices fell approximately 60% between July and November 2021. Copper dropped approximately 20% in the same period. Steel futures collapsed. These are not abstract market movements. These are the input costs for infrastructure projects, manufacturing, and construction in every country on Earth. For commodity exporting economies, Australia, Brazil, Chile, South Africa, this was an immediate and significant revenue shock. Australia's iron ore exports to China represent a substantial portion of the country's total export revenue. A 60% price drop in iron ore is not a statistic. It's a budget crisis for state governments, a revenue hole for mining companies, and a job market event for the communities where those companies operate. Most finance channels covered Evergrande as a Chinese domestic story. They didn't connect it to an Australian mining town or a Chilean copper worker's employment contract. Those connections are real and they are direct. Okay? Now let's talk about the pension fund exposure, because this is the part that directly threatened retirement savings on the other side of the planet. Emerging market bond funds are a standard component of diversified investment portfolios globally. They offer higher yields than developed market bonds, which is exactly why they're attractive to fund managers trying to hit return targets for pension beneficiaries. Evergrande had issued dollar-denominated bonds priced in US dollars, available to international investors, that were widely held inside these emerging market debt funds. When Evergrande defaulted, every fund holding those bonds took an immediate mark-to-market loss. Those funds were inside pension schemes, 401k options, superannuation funds in Australia, and personal investment portfolios of people who had never heard of Evergrande and never would have invested in Chinese real estate knowingly. And here's the thing, nobody tells you about this specific mechanism. The losses weren't just from Evergrande directly. Evergrande's default triggered contagion across the entire Chinese high-yield property bond market. Country Garden, Sunac, Kaisa, and dozens of smaller developers all saw their bond prices collapse as investor confidence in the entire sector evaporated. Funds that held any Chinese property developer debt, even developers that were technically solvent, took losses because the market stopped distinguishing between them. The total write-down across international investors exposed to Chinese property developer bonds is estimated in the tens of billions of dollars. Short spread across pension funds, insurance companies, and institutional investors globally. Your retirement account may have absorbed a portion of that loss without a single line item in any statement telling you why. Okay? Stick with me. This next part is where everything changes. This is the part most people completely miss, and it's still actively unfolding right now. Short pause. The shadow banking exposure inside China itself dwarfs the international bond losses. Short pause. Chinese real estate developers funded a substantial portion of their construction through wealth management products, WMPs, which were essentially unregulated investment vehicles sold to ordinary Chinese citizens as high-yield savings alternatives. Short pause. Millions of middle-class Chinese families moved savings into WMPs issued by developers or connected financial entities, believing they were secure investments backed by real assets. Short pause. When Evergrande and related developers collapsed, those WMPs became worthless or severely impaired. Short pause. Ordinary Chinese savers, retirees, working families, small business owners, lost life savings they had no regulatory protection for. Short pause. The Chinese government has not made these investors whole. Short pause. The political and economic consequences of that wealth destruction, suppressed consumer confidence, reduced domestic spending, increased saving rates out of anxiety, are still compressing China's economic recovery years later. Short pause. And then there's the ghost city phenomenon, which is the visible symptom of the deeper structural problem. Short pause. Estimates suggest there are approximately 65 million vacant apartments in China. Short pause. 65 million. Short pause. Entire cities built and sold, sometimes multiple times through speculative pre-sales, but never occupied. Short pause. Infrastructure exists. Roads are built. Buildings are standing. Nobody lives there. Short pause. This is what happens when a property market becomes purely speculative, when apartments are purchased as investment vehicles rather than places to live. Short pause. The Chinese government encouraged property investment as a middle-class wealth-building mechanism for decades. Short pause. The result was a construction boom that built far beyond any realistic housing demand, funded by debt that is now defaulting across the sector. Short pause. Beijing's response has been what analysts describe as a controlled demolition, allowing some developers to fail while propping up others, providing selective liquidity, and managing the collapse slowly enough to prevent a single acute financial crisis. Short pause. The strategic calculation is that a slow-motion debt deflation is less politically dangerous than a rapid collapse. Short pause. Whether that calculation is correct is genuinely unclear. What is clear is that the crisis is not resolved. China's property sector has not recovered. Developer debt continues to restructure. New construction starts remain significantly below pre-2021 levels. And the commodity demand signal that the world's raw material producers had relied on for 2 decades has structurally shifted downward. Okay? So you're probably wondering, what does any of this mean for your actual financial decisions right now? Short pause. You have agency. More than most people are exercising right now. Short pause. 3 things to understand for your own portfolio. Short pause. First, check your emerging market bond exposure. If you hold any fund with emerging market, global bond, or high yield in the name, look at the holdings. Understand what percentage is in Chinese property sector debt or related Chinese financial instruments. This is not a reason to panic sell. It's a reason to understand what you own. Short pause. Second, commodity price volatility is not random. It is structurally connected to Chinese construction activity in ways that took this crisis to make visible to most Western investors. If you hold mining stocks, commodity ETFs, or are invested in economies with significant commodity export dependence, China's ongoing property sector contraction is a relevant variable in your return outlook. Short pause. Third, this is not a resolved event. The slow-motion debt deflation Beijing is managing is ongoing. Country Garden, which was larger than Evergrande at peak, defaulted in 2023. The sector restructuring has years left to run. Short pause. Building this into your macro awareness, not as a reason to fear markets, but as context for understanding why certain assets perform the way they do, is exactly the kind of financial intelligence that separates informed investors from reactive ones. Okay? All right. So today we covered the full global fallout from China's real estate collapse. From the $300 billion Evergrande default through commodity markets, Western pension fund exposure, shadow banking losses, and the slow-motion debt crisis still unfolding right now, with clear implications for your investments and cost of living going forward. Short pause. If this helped you even a little bit, hit that like button. It genuinely helps this channel reach more people who need this kind of content. Short pause. Subscribe to the channel and make sure you hit the bell icon so you never miss a video like this. We drop new finance content every week, and trust me, you don't want to miss what's coming next. Short pause. And if you want to go even deeper on how to audit your investment portfolio for hidden macro risks like this one, I've linked a video right here. Go check that out next. I'll see you there. Have a prosperous day.